Mr. Barnes, are you there?
Looking sharp.
Yeah, baby. Ready to rock and roll today.
You are.
Yeah. You know what? Can everybody, are we live right now? I think we're live. I don't know that I've got there's Mr. Burns. Hang on one
Yeah,
second.
it's telling me that it can't start.
No, this is John. We're good. I just saw you, so I'm going to hang up.
Okay. You know, I don't remember if we put a waiting room on this thing.
No waiting room. You're live.
We're live. All right, we're live. We're ready to get it. Mr. Burns, are you available to show your camera, sir?
I am.
All right.
Well,
All right,
actually,
all right.
it says you
Jason,
cannot
it's
start.
telling us. Yeah.
It says the video is not allowing me to. It says the host has stopped allowing me to share my video.
That is definitely not the case. We're just going to ask everybody to bear with us right now. We are getting up and running here. Leon, are you showing your video?
Same exact message I'm getting that Mr. Burns is.
Okay.
Let
Let's
me
see here.
see
Hang
if
on
I
one
can-
second.
I might be able to share my screen though. Can you see my screen right now?
Yes,
Yes.
I can see your screen, but I've got to start with the deck before we do this.
Oh, okay.
So let me have that. I'll take that. If you could stop sharing. Um,
Do that. It's here somewhere. Stop share.
So Leon, you're okay, guys. It's so funny. We're live right now. We're just gonna have to bear with us. We're gonna ask for a little bit of grace, if you will. We could all use that sometimes, right? And so you're basically saying, Leon, that you do not have, cannot show your video.
Yeah, I just sent you a text. It says unable to start video because the host has stopped it.
Okay. So let's do this. I don't know how in the world I've stopped it. I tell you what, let's log out and log back in. I'm going to check a setting real quick and I'll be right back on here in a moment, gentlemen.
Okay.
Yeah,
You want us to log out? Okay.
just log out.
All right. I can do that.
All right, that was a quick fix. Leon, try to put your video back on.
Same. I'm still getting the same message, unfortunately.
Okay, log out and log back in because John's video is up now.
Okay.
Guys, just be patient with us. We're having a little bit of technical difficulty. It was typically par for the course, but we will get it right here shortly. Just hang tight with us. We got a great webinar coming up here shortly. We're going to cover off on some killer information. So just bear with us. Can everybody hear us okay? If you could, please let us know if you can hear us okay as well. John, can you say something?
I can hear you great.
Okay, everybody can hear us fine. All right, everybody can hear us fine. All right, all right. All right, all right. Rocco, Shatter, we've got a bunch of great players on the call here. All right, where's Mr. Cava? We're just waiting on one more from our team, ladies and gents. We will get this show rocking and rolling here. Just got to let you guys be patient with us for 1 minute. We will ask you for grace. We already have 300 people on the call. We had 900 something registered, and I expect we'll have 350 to 400 here inside of a moment or two. So again, just please be patient with us. Let's see.
Jason, can you hear me?
I can hear you, sir. We do not see your video. Can you show your video? Frank, are you there?
I am, and it's showing me that the video is up.
Mike
Yeah, so-
Self busting my chops already. A member of the collective genius asked me if I got extra gel in my hair. I do. Tonight, just so you know, tonight, date night at the Medley household, we got a brand new set of hair clippers in from Amazon. We're gonna stick a chair in the shower. I'm gonna grab a beer. My wife's gonna grab a glass of wine, and I'm getting a haircut.
Yeah, this
So-
is the first time I think the bald guys have had a real advantage.
Yeah, right. It's like you guys. I told my barber, I was like, we're gonna need a bulldozer at the barber shop when this whole shelter-in-place thing lifts open. So, all right, Mr. Cava, are you there, sir?
I am here. I don't know why the video isn't working. It says it is.
Same here, Jason. I think you're going to have issues with both Frank and myself on the video. So you've got you and John up. You can hear our audio. So I think you're just going to, I think it's probably best if you move forward without our video.
Yep. That's what we're gonna do, guys. I apologize for the technical difficulties. I'm gonna take a deep breath. I'm a little nervous that we're having some glitches. But it is what it is, right? Much like this market, it is what it is. And so we're going to get rocking and rolling here. So I'm going to, if you will hold on one moment, I'm going to share my screen. I'm going to do some basic intros, John, and then we are going to cut you loose, sir. Does that sound like a plan?
Let's do it.
All right, let's rock and roll here. So let me move this Zoom bar and we will get rocking and rolling. Slideshow from current slides. Okay. All right, ladies and gents, we've been putting this together for about a week now. I actually thought about this as soon as all this happened, but I actually felt it was better to let a few weeks, or I would say a month, go by, John, to actually get some data rather than kind of like do this call right away. So the thing that I want to talk about before we get going is there are a lot of different types of investors on this call, okay? I did a survey that when everyone registered for the call, that we asked you to complete a survey, and I want to show you a slide to help you understand. If you look at these results, that adds up. I told everyone to click everything that was relevant to them. Are you a wholesaler and a landlord? Are you a fix and flip and land? Like, the reason that adds up to way more than 100% is because we let people click multiple things, which means there are a lot of what we call hybrid investors on here, okay? What that means is you may very well generate your own leads, wholesale some of them, rehab some of them, and keep some of them in your portfolio. So the point or the reason that I'm sharing that with you is very specifically, okay, we have a large audience. We have a ton of people on here. There's my man right there at CG. We have a ton of people on this call, and everybody has different disciplines from an investing perspective, okay? So we've done our best to approach this call from a well-rounded perspective, but it's not gonna be perfect. There's gonna be things we talk about that aren't relevant to you and things that we talk about that are. So just be patient. I can assure you that you will be rewarded on this call because we got some great information here. So with that said, I wanna start out by introducing Mr. John Burns. This is a gentleman who's very well respected. He's the data guy, if you will, to some of the leading builders out there. John, I think what you've got, the Toll Brothers, WCI, MI Homes. In addition to that, Home Depot is a big client of yours that you give direction to on trends and which direction to go per se. And you also have a ton of the big SFR funds that come to you for guidance as well. Is that a decent bio there, Mr. Burns? Anything you'd like to add to that?
We got a lot of the big players in fix and flip too, the lenders, the Genesis and the Corvettes, and even the Turex who's securitizing it. So I see that's one of your big groups too. I mean, we're very involved in that. And then also all the iBuyers who are dealing with many of the same issues, so.
Well, and I'm actually glad you threw those two things in there because that's going to be some of the big topics today. I'm going to go over the agenda here in a minute in detail, but some of the big topics today are going to be what's going to be happening with the secondary capital markets, because obviously they've kind of vanished from the marketplace or cut their LTVs, which is creating a lot of challenges for folks. And then from addition, from an iBuyer's perspective, super curious about like, have they packed up their bags? And if they have, is it short-term, long-term? So I'm glad I asked you for some additional input there. We also have Mr. Frank Cava on the phone here. He is on my leadership team. This gentleman is a rock star, complete bulldozer, one of the probably most talented people that I know as far as matching his intelligence with work ethic. What you're going to see here is you're going to see some headlines, if you will. And these are just slides that I've had from previous events we've done at the Collective Genius, because it's important for me to know that some of what we're going to talk about today is not reacting to a storm like this, but how do you prepare before it comes? And I've pulled some slides up here. These are dated slides, right? They're not new. I didn't have them made for this event, online training, but they're dated. And the reason that I'm showing them to you is because to tell you that smart investors prepare and they drive their business from the perspective of knowing that these types of things are going to happen. You've got to expect the unexpected if you've been in business for any length of term, right? And so Frank's been super valuable on our side from a leadership team perspective. This guy flips a couple hundred homes a year, has a rental portfolio north of about 275 units. And Mr. Cava, is there anything you'd like to add before we keep rolling here, sir?
No, we got the headliner, Mr. Burns, and then we'll put some questions together there at the end for everybody. And Jay, I'm
okay, thank you.
on the camera for some reason.
Yeah, I'm not sure why we can't get you and Leon on, but it is what it is. We're going to keep pushing. In addition to that, I've got Mr. Leon Barnes on my team. He's our director of member results. This gentleman is a stud. He's been involved in 320 plus rehabs. He is the front lines for our Collective Genius members. Over a year ago, doing a presentation about start treating your KPIs the same way you treat your kids' report cards, right? That should resonate with a lot of people right now, because that's about data, and that's what we're talking about today. For those of you that don't know, my name is Jason Medley. I'm the CEO and founder of the Collective Genius. We're an organization that consists of about 140 of the nation's leading investors. This is the highest caliber and highest level of culture that exists in our industry. Collectively, our members will flip north of 20,000 homes, have a massive stack of portfolio homes in addition to those number of flips. And we provide a board of directors, if you will, for those members and organizations that meet together on a quarterly basis. Right now, we're meeting every single Friday in an all hands on deck call to address these issues, but we'll talk more about that later. But first and foremost, we are a community. We're a community that places high caliber investors on the fast track, if you will, to becoming visionary leaders that scale their business, build wealth, and give back. And that is what we are helping folks do right now. So, what I want to cover off on before we jump into John's data is there's a ton of uncertainty in the market, right? And that's why we're having this call. Capital markets have dried up for rentals. LTVs are getting compressed with a lot of the folks that John just talked about, some of the clients he mentions, the Genesis of the world, Genesis Capitals of the world, the Lima ones. That's creating a downward pressure on buy boxes, right? Like, they kind of feel like a moving target right now. We've got some great survey information that I've taken prior to this call that you guys filled out, and we'll talk about what a buy boxes look like, right? Because a lot of that's creating risk exposure with regards to how you enter and exit the market right now. Things are just complicated, right? If you're on the coast, it's hyper complicated to show house, to buy houses, rehab houses, and with social distancing in place, shelter in place, and rules, things have just gotten complicated. Marketing has really become like a game of which comes first, the chicken or the egg. I think, John, one of the things that I think you'll find insightful is prior to this call, or 6 weeks ago, everybody was spending money on finding distressed assets, distressed homeowners. And now for inside of our organization, a big shift has gone into finding buyers from a disposition side. So kind of a complete reversal from that aspect of the game. We're also, rental income is getting disrupted. I think a lot of that depends on where you have your portfolio at, which John is going to talk about today, what areas of the country are being impacted the most. And then on top of all this, we get to combine this uncertainty with the fact that we are all about to go stir crazy from being stuck at home, if you will. So I figured you guys could use a little joke to get this thing started. Like, I actually Googled that about a week ago, how to fade your own hair. My clippers arrived last night, and that's going to be a fun date night tonight at the Medley household, and I'm not kidding. So anyway, we all just want to know, like, when are we going to go back to normal, and when will that happen? I don't know that we'll have those answers on this call, but I think we can provide some guidance and direction. That's really, I think, the best that leaders can do right now is give guidance and direction. And so the best thing that I can do really to set the stage before we start to cover off on today's agenda is we are in what I call, I'm almost 48 years old, and I've been through, this is my third, for lack of a better term, black swan, if you will. And everyone says, oh, this wasn't expected. You got to learn to operate from the place of expecting the unexpected. I'm 48. This is my third black swan. We had 2008 and we had 9/11, right? Nobody expected any of it. They just happen. It's just, you don't need to be that smart. You just need to be a historian and have a little experience. And the reason that I have this picture up on the screen is because we are in a spot as investors. There's always opportunity to make money in between economic expansion and if there's an economic recession. But a lot of times we are in what I call the gap. And the gap between those 2 points can sometimes have a lot of uncertainty and sometimes be painful because there's so many unknowns as things unfold and things just kind of, the brakes get hit, right? And I equate it to if you rode a bike as a kid, when you would change the gears on it, when it would go from one gear to the next, right, it would make that gritty, grindy sound. And even though you had some confidence that it was going to catch on the next gear, it was never comfortable. You didn't feel certain or you didn't feel good until that gear caught. And until it does, we are in what we call the gap. So how do we survive the gap? Hopefully we're going to give you some insights on that today. And the thing that I want to share, I want to ask you guys a tough question. And this may ruffle some feathers, but I'm okay with that because my mission is not just to bring you information today, but to help you from a business perspective. Think about if you get a jail out of free card with this thing and we go back to normal fairly quickly, or things, at least the wheels start turning, you got to think about what you learned. And so I want to ask you a tough question, is the coronavirus the problem, or is it revealing the problem for us as entrepreneurs, right? And the reason that I'm asking you that is because, again, this is another slide we've used at the Collective Genius. That house is standing because of the way it was built, the level of care that was taken, and the level of management from the construction process prior to the storm. Everything is decimated around it because they didn't take the same level of care, okay? And so a lot of us have scaled our businesses without regard and not really thought about how to scale the right financial and cash management structures inside of our business. And so that's kind of leaving some of us with our pants down. And so at the end of this call, I want to share something with you, with everybody on the call, that has really truly helped me as a business owner. And again, I had to get hit in the mouth twice. This is my third one. I had to get hit twice to figure this out. But I want to share with you kind of a simple strategy that's put me in a very blessed position right now to not have a lot of worries regardless of what happens. And it's really a simple discipline that I want to share with you. So again, this slide is almost over 2+ years old. We've been preparing our members for this for quite some time. These are slides from presentations that were done. This was 2018. How do we prepare, position, and prosper for coming downturns in 2019? How do we scale to get better versus simply scaling to get bigger, right? And then we've had our resident CPA, Mr. Marcus Krigler, walking us through the tough questions of what to do when your P&L is in the green, but your bank account is in the red. And there are a lot of folks right now in that category who have just scaled, gotten bigger, and didn't really have any regards for their balance sheets along the way. And so, again, tough question. Is coronavirus the problem, or is it revealing the problem, if you will? So here's today's agenda. Then we're going to turn over to Mr. Burns, right? Like, how are market values going to be impacted across the country, and for how long? How long is it going to take for housing to recover after shelter at home is lifted? What is the overall impact of the mortgage payment holiday? Where is safety found in the home building sector? That's a great question Mr. Cava brought to the table. How are rents going to be affected, right? This is a broad question. I think it could be very diversely answered based upon where you are at relative to the job losses from a geography standpoint. And then here's the big one. This is the one I'm most excited to talk about John with. And then we actually have a call for our Collective Genius members at 2 o'clock today, where we have the CEOs, CEO of Anchor Loans, CEO of Lima One, CEO of DLP, CEO of Sherman Bridge Lending, a lot of CEOs from big organizations that are going to come in and give our members some input on where are the secondary markets heading. So, and then John brought this up too. What about the iBuyers? Are they packing up their bags? Are they coming back? When? How long are they gone? Has the capital that they were using dissipated? So, and then are we going to experience a U-shaped, V-shaped, or L-shaped recovery? And where are we going to be in the six months from now? I've got some great data that I'm looking forward to sharing based upon how you guys answer this question. And then dispositions. This is kind of a topic that we kind of threw in here that we thought could be beneficial to everybody. Dispositions is king right now. If you are a real estate investor who is generating leads, wholesaling, rehabbing, putting rentals in your portfolio from that lead generation, dispositions has gotten a lot easier to buy and a lot harder to sell. And so we're going to share with you some behind the scenes of what we are doing as an organization inside of the Collective Genius to absolutely tackle that head on and make phenomenal progress. So Mr. Burns, I am going to be your Vanna White, not near as pretty, and I don't have long blonde hair, but if you will just kind of tell me when to change the slides, we can go from there.
You don't want to let me control it? You want to give up the share?
Actually, I think I can do that. Hang on one second.
Yeah, just do the stop share.
Yeah, let me hit the stop share, and then you can take over the share.
Perfect. Share screen right here, right there.
Guys, also too, if you have questions, there is a Q&A button. We will be fielding some questions here shortly. So just any questions you have, enter into the Q&A button. It's down on your toolbar, basically about 40% over from the right-hand side. So, all right, Mr. Burns, take it away, sir.
So you can see my screen okay?
Yes, sir.
All right, so we just did our 6th weekly webinar since this started yesterday. And so and each one is taking like 45 minutes to an hour. So there's so many questions that we're trying to get answered. And I brought maybe 15, 20 minutes worth of highlights here. So a lot of it, maybe I've got the answers in Q&A. I was guessing what you wanted to see were the highlights of what we're seeing. So let's just do this. So I want to go with the realistic view here. And so I'm going to pick on a few other people who are much smarter than me, but Howard Marks from Oaktree is renowned as one of the world's most renowned realists. He's just finishing up a capital raise to raise the biggest distressed fund ever. He runs a $100 billion fund that does that. And so here are just some of the facts we can't argue about. So, and this is from him 2 days ago. So this is one of the greatest pandemics in 102 years. This is the greatest economic contraction since the Great Depression. So I'm just getting very realistic here. The greatest oil price decline in the OPEC era and probably ever. And then what can be interpreted as a more positive, it may have some longer term negative implications, is the greatest central bank government intervention of all time. So we're trying to manage our business through 4 different greatest here happening really quickly at the same time, which is just crazy. If you haven't seen what Bill Gates is doing, I recommend you doing it. I now know that he's under attack from some right-wingers, so you may completely disagree with this, but to me, he seems like he has researched what pandemics cause and what the most likely timeline is. And he's a business person too. So I'm kind of going with what he's saying, which is plan for about 10 weeks of extreme lockdown, resulting in areas opening up in May and June. Now, I know there's controversy associated with that, but that's kind of what I'm running with. And everything I'm reading is that if you open up earlier, you may end up locking up again. So that's what we're running with. To think of the extreme damage done when we basically tell the entire world, hey, you stay in your house and don't transact with each other, that is just a massive hit to the economy. Who knows when a vaccine is going to become available, but the consensus seems to be 18 months. Let's hope it's next month. And this is going to help answer some of your questions. And this was our conclusion too, but he even mentioned it. This was in an interview he did on LinkedIn. You can look it up for free. But specifically, the recovery for home building is not the same as the recovery for the economy. The economy can fall a big number, pick 20% in a quarter and come back 2, and people call that a V. Or actually, and then if it comes back, you know, it's flat and then comes back 2 another quarter later, people call that a U. Well, hell, you all know the damage done to housing when that happens is pretty substantial, and that the housing recovery, you know, looks more like an L, or the better term is more of like a Nike swoosh. I'm looking, and I'm sure you guys are too, I'm looking at Washington State as kind of an early indicator. They went into this early, probably not as prepared as some other places. So when I start to see the number of cases flatten and decline in Washington, and the number of deaths flatten and decline in Washington, to me, that's a little bit of an early indicator that, hey, it's time to talk about things getting better. And I know there are, like Northern California looks like it's already flattening, heading down. So there are going to be some earlier than Washington. This is from the CDC map. The hotspots now are in the East. And I know you all have different investments in different markets. And while most markets are in a shelter in place and have that in common, the level of health scare is very different. The politics about reopening are very different. Things are very different by market. But I want to show you some of the damage done, but then give you some hope that it's not quite as bad as it looks. So 17 million workers, what is that, like 13-14% of all the employment have filed for unemployment benefits in the last 4 weeks. I mean, that completely undoes all the economic growth in this cycle. This gets us back to like 2006. And frankly, a lot of people haven't even filed yet. So it's more significant than that. And it's not equal by geography, and it's not equal by pay scale, and it's not equal by industry. So I'm going to show you a few things here. The green is generally better, and the red is not so good. So this was an analysis done by the Dallas Fed, where they looked at categories of workers and say, hey, who can work remotely? I mean, somebody who cleans houses for a living or works in retail cannot work remotely. My staff, very fortunate. A lot of you, very fortunate. We can work remotely. About 39% of the US can work remotely. So that tells you 61% are taking some sort of a big hit here because they can't get their work done. It's a little bit less in Texas. It's much more heavily skewed to people with a college degree. It's much more heavily skewed towards people that make higher income. So to the extent you're selling homes, for example, you're better off than renting B and C apartments, because if you've got B and C apartments, you've got more lower income people in there. And then it's not even the same by geography. Austin, which has a lot of those high paid tech workers, almost half the people in Austin can work from home, but less so in San Antonio. And I think there's been an overemphasis that's now starting to get figured out into the damage. So the first ones to go down were the airlines, the hotel, and the retail, right? And at least a lot of my clients, and I'm guessing a lot of yours too, were saying, well, hey, those aren't the home buying population. That's you know, those are the most unfortunate, lowest income people in the country, and that's true. But as we move into this, you start cutting into other businesses, particularly ones where payroll is a big chunk of their expenses. So when your revenue falls and then April 15th comes around, or March 31st comes around, and then April 15th comes around, you have to keep writing payroll checks. A lot of companies are just being hit. So it's not just the low paid now, it's everyone. We're hearing of layoffs at lawyers' offices, at medical practices. I don't know when people are going to go to the dentist again. This is starting to hurt some major businesses, and it is not even. So the manufacturing businesses in the Midwest, Michigan, for example, 1/4 of the employees in Michigan have already filed for unemployment. Just devastating. Nevada, which is all about the casinos, obviously, and the conventions, and that's down for the count, if you ask me. Other areas are behaving differently. And then one of the things I wanted to share with you, because it's a demand supply for housing issues, is in a recession, really the worst thing that can happen is a lot of construction that then comes onto the market with all these never been occupied before homes that need to get occupied. And that can be for sale homes or it can be for rent. I brought the for sale piece of it here. Here's the number of actively selling communities. And the red means that the communities are actually trending down into this. So it's a little bit less competitive than it was a year ago in Dallas, Indianapolis, and Portland. But the green would be the communities have been trending up. So it's a little more competitive in DC, Raleigh, and Tampa. So it's not just the absolute number, but from the apartment standpoint, which I didn't bring that one, we are at a 33-year high on multifamily construction. So we are going to see a lot of apartments finish over the next 12 to 18 months, open up empty and need to lease up. And that's why the apartment market is historically so cyclical, is because it's very dependent on the economy, and then you can see a lot of new supply hit. So we spent almost a half an hour yesterday going through all the federal government programs to explain them to everybody. So this is the positive, if you will. And I'm not going to go through it in a lot of detail, but I got to tell you, they're getting things done there like I never thought the federal government could get things done. The SBA, through that PPP program, has made more loans in the last 14 days than they did in the prior 14 years. I mean, whoever thought the federal government could do that? The IRS, which is known as a horrendous bureaucracy, has somehow managed to get deposits into people's checking accounts already. I mean, this is actually happening a lot faster than I thought it was going to. So the federally elected officials, the people overseeing mortgage policy, which more than 60% of the US is controlled by the federal government, which is actually going to, in a very crazy way, help things here, because you do have one or two decision makers that are the government that can change policy and make things happen. Imagine if we were back to the old days where it was all pretty much on non-regulated, all being done by the banks all over the place. And then of course you've got the Fed. So I'm just going to give you the conclusion here from all the work we showed yesterday. We do these webinars for our clients. I know maybe about a dozen companies on this call are also clients of ours. But let me show you what's going to happen positively, but then also when it expires. And one of the things I learned during the last downturn, if you remember, they offered a $10,000 tax credit to anybody who bought a home. They did it twice. And it stabilized home prices, and it actually improved the market until the $10,000 expired. And like the day it expired, then the market went back down. So they've got these things that help and then expire, help only temporarily. So first thing they did on March 14th was they passed this family, I forget what the FFCRA stands for, but the Coronavirus Recovery Act, Families First. And it was $105 billion. It allowed a lot of people who either got sick with COVID or were now working at home and there was nobody to take care of their 2- and 4-year-old to apply for essentially the equivalent of a family leave for about 12 weeks. And you can make the equivalent of $52,000 for some of these people just staying at home. So a lot of people jumped on that, but that is good for 12 weeks. So it's going to run out for those people at some point. Then the payroll protection plan, which was for businesses of less than 500 people, 500 employees who were damaged, could apply for essentially 2 months worth of payroll. The federal government was going to cover your payroll for 2 months. It's a little more complicated than that, but it covers it for 2 months. So I think it's going to help a lot of companies stay in business. It's going to help a lot of companies go from losing money this year to maybe even making money, or maybe just losing less. But if they decide that our revenue is down 20 or 30% from the peak, once I've got this assistance done with these employees, am I going to employ everybody when my revenue is down 20 or 30%? Probably not. So there's going to be some stimulus here that's going to be very helpful. It'll actually bring the unemployment rate down, because it allows you to hire back people that you let go. But I think there's a potential here for a double dip, if you will, once those 8 weeks expires. And the checks are pretty much hitting over the next 2 weeks. So I would say this is the end of April. It would be the end of June when this runs out.
And John, just so everyone knows, that $350 billion is gone.
Yeah.
I think it took a total of maybe a little over 2 weeks from in and out, $350 billion gone. But hopefully they're going to be bringing some more to the table, because I agree with you completely that this may sustain some level of employment, but after this first batch, if there isn't more, yeah, we're going to be faced with the same challenges in 8 weeks of the realities of decreased revenues and can we maintain overheads?
Right. Then this is what the IRS is sticking in everybody's checkbook, or 90% of households in America are getting an average, I think, of $2,400. So some of that will end up as stimulus, it'll get spent. Others of it will just end up in savings account. From a home buying standpoint, actually, that could be the difference between somebody who feels comfortable in their job having enough for a down payment and becoming a home buyer out of this. So I'm optimistic there, but obviously being offset with a lot of other people who maybe aren't secure in their job. Then there's an additional $600 a week bonus for 4 months if you file on unemployment. And if you we did the math on an $80,000 person. I know that's a little bit higher, but our clients are a little bit more skewed to selling to affluent people. If you file for unemployment, you're basically making the equivalent of somebody that makes, I think it was about $52,000 to $60,000 per year for 4 months. And so, I mean, so there's a 4-month cushion. That's having some unintended consequences. One of my clients, and you probably have these people in your property management business too, but
why would you want to go back to work?
Well, he owns a bunch of assisted living facilities.
Yeah.
Those people make less than that. They're highly exposed to getting sick, and they're afraid to death that they're the one that's going to bring COVID into the assisted living facility. They can't even get their employees to show up there. So there's been some damage, unintended damage done there, but this is going to expire too, that extra $600.
So just so everyone understands, because of the unemployment that people are receiving, if they can end up in a situation where the amount of unemployment is equal to an annualized salary that's greater than what they were making prior to this happening. And so then they're making choices to show up to or not show up to work, or just to not go at all based upon if they're making, they have more money in the bank prior to this happening. So it's interesting tug of war.
Right, and there will be some savings there too. Student loan forbearance for 12 months, but then the payments come back. Forbearance is not forgiveness. Mortgage forbearance for 6 to 12 months, but that's not forgiveness either. So that's either going to end up in a loan modification, some debt forgiveness, or a foreclosure. But if we're not going to foreclose on anybody or even start the process this year, when do you think that distress happens? Not this year.
Right.
Next year. So
2021.
So if you're thinking this through, and all the rules can change, but there's probably going to be more competition on distress sales if you're a seller, or more opportunities on distress sales if you're a buyer a year or two from now than there's going to be this year. And then rent forbearance, same story there. That's not forgiven. And one of the things I think people forget is that about if you sign a year-long rent, about 8% of leases expire every month. So not only are you seeing people not pay their rent, but you're also seeing leases expire and people just not renew and then leave because they're already living with mom and dad. I mean, I'm very, very bearish on the apartment market through all of this. So I know you like data, we do too. So we've shifted our staff into creating all sorts of new type of data we didn't have before, and we're updating it every week. And one of the best things I think we're doing is we're blasting our entire CRM and getting more than 2,000 people to fill out every week, hey, how's my business doing? And we're now able to build some trends. So I'll show you a little bit of this. So it's skewed to our clients. So This is what they're showing, and not a big change here. But the yellow, which would be the demand for whatever I'm doing, is staying about the same, grew a little bit. The decrease declined a little bit. I was surprised. A number of my clients actually sold more homes, the home builders, last weekend than the weekend before. There is some pent-up demand that is building, and I actually think as we go out of the shelter in place, we could see some pretty good sales, but it's just temporary from the pent-up demand. And then if you look at it across our client base, our private equity guys are already starting to see more demand for their services. We're hearing about some transactions getting ready to happen there from willing distressed sellers. The lenders are actually making a lot of money with some of these SBA loans, so they're doing okay. And let me show you the trend. So on the development side, things are getting a little bit better. On the private equity side, things are about the same. The investment funds, that's the stock market. On the rental side, I mean, there's not a lot of people saying really positive things. And you mentioned this, and the rental distress is not the same by market. In fact, there's far less in Texas and North Carolina than there are in other areas. I'm already learning that some of these stimulus checks really help people in affordable areas a lot. I mean, that's enough to pay 100% of your rent, or this unemployment assistance is enough to pay 100% of your rent. But if you're in Northern California, it barely does a thing.
You know, hey, John, is we've got a slide I'll share with you in a little bit. We only had about 350 people fill out the survey that we put out, but the combination, it was a multiple choice question, but almost 80% of the folks that filled it out said that the sentiment from their renters is, we will pay it as long as we can, regardless of what's going on, or, hey, we're in great shape, don't worry about it, we're going to be able to pay our rent. It was almost 80%, so pretty interesting. It's definitely geographically based.
Right. So listings remain very low, and just looking at the absolute listings data, it's tough to make conclusions. There's actually a guy from Redfin, Taylor Marr, I think his name is, who's doing some really good analysis on this. But listings were down 19% at the end of February. They're down year over year at 16% at the end of March. So you've not seen a surge in listings. In fact, people are pulling their home off the market. And they're not seeing a lot go on, but the real estate agents that we're talking to are saying that we're seeing the listings of the people that really want to sell start to drop price. So prices are falling amongst those few listings that are out there. This is getting less interesting, but very early on in the cycle, the Google searches for new homes and resale homes and apartments was quite interesting. We saw a lot of people getting the hell out of an apartment, because who wants to be living wall to wall with 300 people when coronavirus is being spread, and into single family rental. I mean, people wanted to get into a detached environment. And I actually think over the next 12 months, you're going to see more of that as an apartment lease really does expire and the person needs a place to live. Why not go rent in a house somewhere? And so this is some data we just got from our team yesterday. This is 115 metro areas, and we do have it for every metro area. But in these 115, the median list price was $359,000 a year ago. You can see early last month, it was up to 370. Now it's down to 357. Now this is apples and oranges, because they aren't all the same homes. So there could be a little bit of a mix there, but I think if you look at the list price, March 27th, April 3rd, April 10th, I think a lot of those homes are the same. So you're probably seeing a little bit of a price decline there. Encompass California did a survey of all 700 resale agents in California, and that was the conclusion they pulled from surveying their real estate agents too. You know, the government is giving everybody a payment holiday on their rent and a payment holiday on their mortgage. So this is forbearance, means that you have contacted your lender and say, hey, I'm not going to pay this month. Let's figure this out. You can see that is trending up. Ginnie Mae is FHA, VA, and USDA. So we're already up to 6% of borrowers in that portfolio. where it was only 0.19% a month ago. So you've seen a lot of distress in the FHA portfolio, less so in Fannie and Freddie, because Fannie and Freddie tend to require more down and higher FICO scores. And it's pretty consistent with what I showed you earlier about where the distress is much more likely to be in the lower income profiles than the higher income profiles. And then mortgage rates usually trade at a 1.7% spread over the 10-year treasury, because a typical pool of 1,000 mortgages usually pays off after 10 years. You got somebody who refis after 1 year or sells their house, and somebody who holds on to it for 30 years. The average is 10. So that's how mortgage securities trade, is based on the 10-year. But that spread over the 10-year has blown out dramatically, because who wants to buy mortgages right now when everybody's going into forbearance? So you're seeing a lot of distress going on in the mortgage industry. I could get into the whole mortgage servicer thing last week. I spent a ton of time on that. I'm not going to. But the way I would summarize it is, be very careful about what's going on in the mortgage market. There are some pretty solid mortgages that were made and committed to and locked in a while ago that are closing. But on a go forward basis, the banks and the lenders are pulling back and being far more cautious about who they're lending to, particularly on a high loan to value. I mean, that's.
I'm not sure if you saw this too, but there was a line drawn in the sand on 331 where the FICO scores changed drastically if it was underwritten by FHA, and they actually, like, they had to push things to close, or it was like, we're not going to close it in April. Did you see or hear that as well?
Well, I don't know if the FHA did that, but I know the lenders did. I mean,
it was the lenders who were underwriting it, right?
Well, the biggest risk for a lender, frankly, is that if they make a loan to you and then the first month you miss your payment, they can't sell that loan. They are stuck with it. And then also, that's the one that they said, well, you probably didn't verify that guy's income. And so that's the one where they go after the underwriter. So they are scared to death right now of making a loan to somebody who's going to miss their first payment, because they're going to have to eat it. And Jason was alerting to this earlier, we, through a lot of different sources, figured out that the defaults were about 9% higher than usual in apartments a week ago. We got better data now, and it looks like it's about 7%, with big differences by geography. So 7% more people than usual didn't pay their rent this month. And, we're hearing May is likely to be worse. And I mentioned Texas and North Carolina, not as much of an issue. I want to bring up an old workout term, the difference between economic occupancy, which is the percentage you're paying, and the physical occupancy, which is the percentage that are occupied. So some of these buildings now could be 96% full, but only 85% of their tenants paying. That's a pretty tough situation to be in if you're a landlord, and it seems like you've got a number of landlords on the line. The single family rental guys are disclosing what's going on. I would say the summary here is nothing too distressful for them. They're probably a similar or even a little bit better than that in terms of rent collection. And then finally, we're trying to stay positive too. So we just introduced a new Friday email as a great way to end the week. Opportunities ahead with the light at the end of the tunnel. That's something we're doing for free on our website, realestateconsulting.com. You can sign up for that. And that was probably enough slides for a Friday morning or afternoon, depending on where you are. and I'm happy to take whatever questions you've got.
All right, so let's do this. Let me, I'm gonna take the screen back here real quickly. Hang on one second, ladies and gents.
I just did the stop share.
Okay, thank you, sir. Let me get to the appropriate slide here. And we'll get back up and running here as far as asking some key questions from everybody.
Hey, Jason, while you're going into that, let me hit him with a couple of questions.
Yep,
John,
you
started started off by saying something about the lenders and FHA and all that stuff. Where do you guys see trends? Like, do you see there being, what are you hearing? So let me ask a better question. There's three segments of market. There's like government or FHA. Then there's kind of like your mid-range and your jumbos. So your conventionals are kind of in the middle. Are you seeing three separately spinning plates? Kind of where do you see all that going?
Yeah, there's actually four. So FHA was in a boatload of a distress 2 weeks ago because the mortgage servicers, who are the people who collect the payment when people pay it, are required to distribute the entire payment, principal and interest, even if the person doesn't make it. So they were going to run out of cash. So Ginnie Mae, who oversees this, actually used this incredible program to come in and bail them out. So the FHA distress, in terms of it all the lenders blowing up, is gone, but the distress of still that risk of lending to somebody at a high LTV who might miss their payment is still there. The GSEs, Fannie and Freddie, the conventional financing, that borrower is higher quality. But the regulator on that, Mark Calabria at FHFA, has said, hey, mortgage servicers, you still need to make a bunch of the payments too. We're not going to bail you out. You were supposed to be prepared for this. So he's playing chicken there. So now the banks are scared about making, or all the the servicers, who are also a lot of the underwriters, the non-banks, are scared to death about their business there. So you're reading a lot on that. The jumbo market has moved to, okay, if you're a 70% LTV and a 800 FICO, you're in, but that's about it. And a lot of attention has been given to this other part of the market called non-QM, which is, you didn't have the documentation, you were a doctor, you were self-employed. That's completely blown up and taken out a couple companies. So those type of loans, if you don't have perfect documentation, there's no loan for you.
So based upon that, John, that kind of precludes the next question here. What do you envision happening given mortgage underwriting guidelines getting tighter, given everything that's taking place? What do you envision happening from a values perspective? And again, I got to go back to the way we started the call today. This is going to vary based upon where you are at in the country. So, giving a broad-based answer is really probably the best we're going to be able to do. But what are your thoughts on values, John, over the next 3, 6 to 9 months?
Well, other than that pent-up demand, which might be a bit of a dead cat bounce, it's pretty obvious there's going to be fewer home buyers than there were going into this, a lot fewer. And there's probably going to be more home sellers, with most of the distress being a year or two from now. So we all know what happens when demand goes down and supply goes up. What percentage to put on that, I have no idea, and it varies by submarket and yada, yada, yada. But the industry, my clients, are preparing for prices to trend down. I showed you a little bit with what's going on in the resale market. The home builders are now playing this game where they're not going to drop prices until they get their backlog closed. But once they get the backlog closed, then it's a free-for-all.
Yeah, and just so everybody knows, we had about 300 or so folks fill out this survey, and about, let's see, 27, 48, 50, about almost 60% of folks who filled this out are adjusting their buy boxes down. And the majority of them have adjusted down between 10 and 20%. So you have got to be extremely careful right now with the level of aggression that you're putting forth in buying distressed assets. You've just got to be extremely cautious. And then you've got to even be more cautious as we ease back into normal, not getting emotionally caught up in the dead cat bounce, right? Because you might see demand kind of kick back in, things start to pick up, but that's the pent up demand, which may be short lived. And so you got to be cautious not to overbuy into inventory and carry too much inventory. When on the other side of the dead cat bounce, the pent up demand means things soften again. So you've just got to be hyper calculated. This is going to expose a lot of people. When we're in a bull market for 10, 11 years like we were in, a lot of people had the wind at their back, and they were lucky, they were kind of like a sucker fish on the market. And now we're in a situation where those folks are going to be exposed. And so you're just going to have to be, extremely cautious to be able to navigate through this. And then, again, John, obviously another tough question, but as we begin over the next 3 to 6 months to lift the shelter in place type of things, how long do you envision before we are effectively back where we were 6 weeks ago?
I mean, I think anybody realistic would say that's going to be many years from now.
Okay.
And you just look at that stimulus chart that I put out, and you just ask yourself, when are all the businesses that were open in February going to get 100% of their revenue back? And when you know for sure that a lot of them aren't even going to reopen, this is going to take a long time.
So everybody be prepared, right?
But you asked the question getting back to where we were. It doesn't mean things couldn't, find a bottom and improve.
Well, and that really goes back to my point earlier in that if you're a real estate investor, regardless if we're in expansion or recession, there's plenty of opportunity to run a good, profitable business. It's in the gap that can, do you have, when this all first started, I created a video and said, if you want to figure out how long you're going to be or how well you're going to do through all this, the first place to check is your balance sheet. And so that's going to be a real good indication of how you're going to do throughout this process. If you have less than, if you don't have a decent amount of cash to be able to survive through this for an extended period of time, or until we at least, once we find a bottom, we're fine, because that's when things kind of stabilize and we know how to adjust and figure out what values are, and we can then get back to the normal processes that are kind of broken right now as real estate investors. But either way, during the gap, you're going to have to really, really be hyper cautious until we get to, if it is a recession, until we get to a part where at least we have enough data to make sound decisions. Frank, I feel like we answered this question fairly well here. Do you think that's a fair statement? John, Frank, I think we just kind of covered off on this?
I think so.
Basically that the opportunity, the mortgage payment holiday delays foreclosures, et cetera. And so if there are a lot of foreclosures that will be brought to the market, I think John basically said he thought it would be, into late next year before that actually kind of came to fruition. From a home building sector, you just kind of touched on that briefly before we segued into that last question. Where is the safety found in the home building sector right now, John, from a new construction perspective?
You don't want to be across the street from 3 or 4 or 5 other desperate home builders, particularly publicly traded home builders. So the publicly traded home builders actually are very well capitalized to get through this. Almost all of them have been slowing down their business anyway, just because it felt like it was the end of the cycle, not taking on a ton of debt. And to the extent they took on debt, it's not due for years. So they've got debt, they borrowed at 4 or 5%, and their first payment doesn't come due for 3 or 4 years. So they're going to be all about cash generation and covering their overhead. And, the publicly traded guys, the private builder has a construction loan on every project and has to deal with the bank on a 1-by-1 basis. And if he's got one of the publics across the street from them, it's going to be tough.
Yeah. How will rents be affected? Go ahead, Frank.
John, how long do we have you?
I don't think I have anything at 10, so I'm okay.
Okay, keep going, Jay.
Yeah, how long? You said something earlier about the fact that there's a lot of new supply coming online from an apartment perspective, and then we've got that combined with a ton of job losses and higher unemployment. How do you envision multifamily is going to be affected from a rent perspective, and how do you envision single family is going to be impacted from a rent perspective as far as actual rents?
Yeah, I can't imagine apartment rents don't get, and I don't say this lightly, just crushed. They just lost a lot of their tenants. They just had the federal government overwrite their contracts with their tenants saying, hey, they don't have to pay you and you can't evict them. And now they're going to get a bunch of empty apartments dumped on the market when these projects get full. And then you want to throw in a health perspective on top of that. Do you want to live in a building with 300 other people, or would you rather live in a lower density environment? There's not many apartments who have so little debt on them that they can survive that. So it's just going to be one big, massive loan restructure that goes on for a very long time.
And do you envision, a lot of times assets are broken into kind of A class, B class, C class, D class. Do you envision the A class asset that has the folks who can work remotely, that have a higher level jobs? Do you envision those A class and B class apartments are gonna take a lesser hit relative to what you're saying?
I mean, what's always happened in the past is they've dropped their rents to the level of the B and C tenants and get the B and C tenants moving over to an A apartment, which is just a hell of a lot nicer place to live for the same rent. So it trickles all the way down. So I don't think one really does better than the other.
Sure. Sure.
We provide affordable housing in our marketplace, and to your point, John, we saw an influx of people, but we saw downward pressure almost immediately on the price if you broke down like price per door, price per bedroom, it fell very quick within a week, and it usually starts at the high end stuff and it works its way down.
Well, and these are the things, right? If you're an investor right now, we've talked a lot about the general. I'm not a big sports fan or a big hockey fan, but everybody knows who Wayne Gretzky is. And he used to always say, you've got to think about not what made him great was not necessarily that he was a fabulous athlete, but mentally he thought about where the puck was going versus where it is. And although the survey that we put out, basically showed that your tenant sentiment was, they're going to pay as long as they can, regardless of what's happening, or they're solid and they'll continue to pay rent. That's 88% of the respondents. At the end of the day, that is today. And you've just got to think about and make decisions on where the puck is going as you navigate through this. John, this is this is the question that of all the questions we're talking about, this is like the main one that I wanted to cover on today. And so a lot of the growth from a single family investment perspective has been funded by the secondary capital markets. They were the ones providing the inexpensive capital to build rental portfolios. They've been the ones that have really over the last 5 or 6 years come into the single family fix and flip game where they weren't there before. It was all driven by private lenders. And from a long-term debt perspective for rentals, it's basically evaporated completely. And from a short-term fix and flip perspective, a lot of the LTVs have been cut and guidelines have become more stringent. What are you hearing? Are they coming back? When are they not coming back because they're going to be able to get better returns in the equities markets? What kind of feel do you have for that?
I mean, I think they're getting hammered, and I think you know that too. So,
yeah,
and on a more positive note, some of those companies, other arms of them have said, hey, my fund 5 is getting killed, but I've got a fund 6 I can deploy. But I know it's too early to deploy fund 6.
Yeah, exactly. This still has to unfold a little bit. So guys, that's really feeds into what we're going to talk about a little bit from a dispositions perspective, right? If these folks don't come back, or if they do, guidelines are tight. A lot of these folks are lending to people who don't have very good very good businesses. They're not experienced. They were really being carried by the momentum of the market. And a lot of those deals are probably going to go bad and get dicey. And they're going to be in management mode of that. And so you've really got to take that into consideration as far as how you move forward and how you look at exiting deals in particular. This is a telltale sign of what is going to become the reality of the marketplace. I think in another month from now, that top answer gets much, much bigger, that people are going to need private lenders moving forward. So right now, buyers and lenders have become the new currency. 6 weeks ago, it was all about getting inventory. It was all about distressed assets. It was all about marketing to sellers, and that has switched almost in an instant to how do you market for capital and how do you market on the disposition side. So hope everybody's listening.
Hey, Jason, Frank. We've only got a couple of minutes left with John. Can I do this? Can I just quickly go through the questions and I've kind of got them. There's 22 questions, which we're not going to get through all of, but let me kind of summarize them, John, and we'll just hit you with them real quick. One of the big things, you said it, but I kind of want you to restate it. Where do you see the home building sector and the rent sector in 12, 24, and 36 months based upon what you're hearing now? That's one of the major questions asked 10 different ways.
Yeah, prices will be lower, rents will be lower, construction volumes will be lower. Basically, it'll be a much smaller industry.
There were several questions about there's several questions about like the opening of the government, and if it doesn't work out, like, I think you and I have the exact same crystal ball. Who the hell knows? But moreover than that, if it doesn't work out, the consumer confidence is going to plummet, right? Like it this ain't going to be better.
Well, that's what I think, but there may be some dead cat bounces on that. I mean, there's a lot of consumers that just got a deposit from the IRS. I mean, that's good for your confidence. You know, one of the questions I have actually for you guys is you talk about lenders. What lending category is doing okay? I mean, I'm talking to the banks and even the, you know, well, like, gee, I lend on hotels, I lend on apartments, I lend on receivables. I mean, just like everything people lend on is getting hammered. I mean, there might be an opportunity really, frankly, to start a brand new bank with no issues, or a brand new lending company with no issues. Just your competitive advantage versus those that have got problems would be huge.
The way you're saying that, are you basically saying, how is that applicable in any way? Like none of us, there's a few people on here that are lenders, but how is it applicable, or how can that be capitalized upon?
Well, I'm assuming there's a lot of people here that know how to raise capital. There's a lot of people that still have a lot of money and don't know where to deploy it. In fact, my understanding that's one of the reasons the stock market is up, is they just don't know where else to put it. There's going to be a lot of people with good businesses and good assets who need a loan. And I think that's a good opportunity for somebody to make those on. I mean, if you find an apartment building, in fact, I know of one that's trading at like 50 cents on the dollar, apparently in Florida, but I bet that guy can't get a loan on it right now. I mean, I would lend 70% LTV on somebody getting something at 50% off, and I'd probably charge a pretty good rate for it. And there's probably not a lot of people who could do that right now.
Well, and that's what's going to happen eventually, right? That's what this goes back to. A lot of this goes back to when we talk about making it through the gap. Private lenders are going to come back to the space, especially if Wall Street doesn't return, if we're talking about on a single family level. But at the end of the day, private lenders are not going to lend money to you at what the guys from Wall Street were. They're going to have a higher rate of return that they're looking for, which means that in order for the deal to work, for the deal to pencil, the deal to be profitable, that the price of that asset has got to be lower than it has been in order for the investor to pay the higher yield that a private lender is looking for. So, it goes back to what we said earlier. Your shift in focus has really got to be to raising capital.
Yeah, I mean, you brought up the iBuyers. I mean, they've got thousands of homes they need to sell. Who's financing the buyer on those? The home builders have got thousands of spec homes that are finished or about to be finished. I know they're talking to some big groups about buying all of them. But who's going to finance that? I mean, it doesn't even have to be high yield. It could just be 50. It could be low risk.
Right.
One of our members last week said people have gone from looking to what their return of capital is to will their capital be returned.
Right.
And a safe haven really works. All right, let me pivot this a little bit. So most of the people that are on this call, our balance sheets are, I can tell you this personally, my balance sheet is way better than it was 10 years ago, but I'm not a publicly traded company. My balance sheet doesn't look anything like those. So a lot of us are speculative in nature. We get in and out of something, we buy it on spec, on the back end, we hope to sell it on spec. Where do you see safety in the next 12, 24, and 36 months? Clearly lending, you said that a second ago. Yeah,
I mean, it's a low LTV loan on underwritten very conservatively seems safe to me. And I know there's questions on here on inflation and things too. So there's a camp that we're going to see a lot of deflation. There's a camp that's saying we're going to see hyperinflation, and there's a camp that's going to say we're going to have deflation followed by hyperinflation. And I don't know the answer to any of those things, but there are people, myself included, who think about that and go, well, gee, I probably want some of my assets in something to protect me in deflation and some of my assets to protect me in case there's hyperinflation. And the hyperinflation guys look to real estate, because you know, if the cost to build a building goes up 50%, you want to own a building now that will be below the cost 5 years from now. And if you can get enough rent to cover your debt service, that's an inflation hedge. So there are people thinking that way, probably not with 100% of their capital, but enough that there will be opportunities.
So John's about 10 minutes over what we promised. So here's what we're going to do. I'm going to make a statement and kind of put a question with it. And the reason
Hang on,
for
let me
it is this.
clarify something, Frank. Hang on 1 second. John, I want to clarify, and this is not to push you beyond limits. I thought we had this scheduled for 90 minutes. Is it an hour? Because if it is, we want to get you out of here.
I have a call in 22 minutes. So as long as we're done the next 22 minutes, we're fine.
All right, let's rock and roll, Mr. Cava.
Then we'll run it longer. So this is what I hear. I was with a publicly traded company in 2008, and you and I have talked about this, John. What you said a second ago is they want to get through their current inventory, and they don't want those comps to hit where there seems to be a price slashing. So what I think is happening behind the scenes, and my friends that are still with big builders, is they're doing everything they possibly can that doesn't show up in the tax record or on the HUD. They're giving free basements and all kinds of other stuff. So for those of us that are in this space, there's going to be a lot of push to keep values where they are at the moment. So this is my opinion. If you were speculating and you're going to sell something in your market that's 3 or 4 times median price, like in my market, that's $750 to $1 million. What we're doing is de-speccing it, making it so it fits into the conventional bucket, and we're going to try and get out of it quickly. To me, I think speed and price are 2 places of safety, and I think a human need is shelter. So if you can be in that bucket going forward, that's where I see safety. Do you agree, disagree, or like how would you guide the folks on this call that see that?
I mean, I would agree, but I think there's also an element of, I would not go all in on any one strategy. I mean, if you're cash strapped and you know you're going to need to sell your assets, I think you're probably going to get a better deal on them now than you will a year from now, if that helps.
I think that's great insight.
And you might even get,
Yeah. Well, and speaking of a year from now, I asked everybody who took this, it was about 300 plus folks, where they thought the economy would be in 6 months. And, it was back to normal, in a recession, in a depression. Then I had another box of people want to make comments, but about 70% of everybody thinks we're going to be in a recession or depression, which echoes much of what you are currently saying. So, Frank, do you want to run the Q&A, or Leon, you want to run it? You want me to run it? How do you guys want to handle this? We got quite a few questions stacked up, and I want to make sure that they're good, intelligent questions.
Yeah, Frank's filtering them. He's going to continue kind of rapid fire here with John.
I mean,
Okay.
John, what do you?
well, somebody
Go ahead,
fired
John.
the question, it's a better deal a year from now. I was talking about as a seller, you'd probably get more selling now than a year from now, not as a buyer.
Someone asked the question, what are the effects on Airbnb and iBuyers? Are they going to go away? I know Jason asked about the iBuyer part, but what about the Airbnb side?
Airbnb is a great question. I really haven't studied it. One of my clients just made a massive investment in them. So, and I didn't advise them on it. So that's a great question. I don't know the answer to. I think the iBuyers, some of them have just really hurt their reputation pretty dramatically when they pulled out of some of these contracts. Could that be viewed as a one-time blip? Maybe. You know, I think it's really up to their VC partners how much they want to keep funding them to see this through this. The whole disruptive companies that want to disrupt the industry and are losing money going into this, there's actually two ways to look at it. You can go, oh my God, this is the worst ever, let's shut it down. Or you can really say, all the people we're trying to disrupt aren't going to make it through it, and we're going to be the main player coming out the back end. So those are the conversations the venture capital firms are having, and I think it's probably a company by company decision. And then the last thing I'll say on the iBuyers, and people were already talking about this, I don't think we needed that many of them. So I don't think they're all going to be here 5 years from now. But there's still a role for somebody to take care of somebody's contingency sale for a fee.
Agreed. I know you don't have a crystal ball with this. EIDL and PPP. So the payroll protection is out. A lot of people want to know, do you think there will be a second round of that? Do you see anything that trends in that direction?
I mean, I don't know any more than anybody else. I would think so, but I'm not any smarter than anybody else on that.
One of the things that was brought up to me on the EIDL is it's currently closed. They're not incorporating anything. They're not accepting new applications. But one of the questions that I saw over here is, if they did a 30-year loan, the government did a 30-year loan at 3.5%, that's actually a better yield than they get on a bond. Do you think that's something they may aggressively try to push towards and help small business with a cheaper cost of capital?
Well, the PPP is 1%. Yeah, I mean, the government is all in on helping employers keep people employed, and that's what this is all about. And I don't think that stance is going to change 3 months from now.
Nate Trufino asked a question. Sorry, Nate Trufino. What feedback do you have when looking at both SFR and multifamily investments in primary versus secondary or tertiary markets?
I mean, the only real difference I'm seeing, well, first of all, I mentioned Texas and North Carolina are doing better. It's all about the
Can you say why?
Well, I think the economic distress hit there later. I also think that, and this hasn't played out yet, but it is going to, that $1,200 or $2,000 goes a lot further in those markets than it does in some other markets. I do have a large client who owns apartments all over the country who said that they're expecting their Midwest portfolio to do better just because A, the type of people that they rent to, and B, the rents are lower and the assistance that people, the unemployment, the extra $600 doesn't differentiate by cost of living. So it goes a lot further in certain areas. Yeah. So the places that are getting helped and are more affordable should do better. I caveat that a little bit with they tend to also have a lot lower educated people too. So I don't want to be that simplistic.
There's a great question from Lee Arnold, Frank. How will possible change in administration change the recovery period? If Trump is out and Biden is in, how does that change the outlook?
I have no idea. I'm sorry.
That's why I didn't ask it.
I saw it there.
Yeah, I was like, that's a great question.
Well, I mean, a couple things you can say. So, I mean, Mnuchin and Treasury, I mean, if he would be out and somebody else would be in. So at least you can kind of predict what it would be like if somebody was still in. If you get a new administration with new people, it's going to be really hard to predict.
So two questions
John,
that just came in. Go ahead, Jay.
Let me grab this one real quick. What data are the big REITs asking from for you, and what advice are you giving them?
I mean, they're just, so these weekly webinars that we're doing for our clients have just exploded. And some of this real-time data that we're doing, I showed you a little bit of it. And so that's what they're asking for, is that, I'm running my business. You guys do this for a living. Go figure out what the hell's going on and show it to me so I can make decisions. And that's what they're really asking for, more data. And fewer of them are asking some of these forecast questions because they know about the uncertainty, but just kind of tell me what's going on now and make sense of all this for me. So I can figure, and I can layer that in on top of what's going on in my business. So a couple of them
Funny
are
you say
getting
that, right?
really. Well, you know, what I am seeing is a big difference on some of them that have their own data and are very sophisticated with their own data and have a lot of answers that I don't have because they're collecting data on, like, I mean, at a crazy detailed level on their own portfolio and the submarkets that they're in. I mean, I got some big companies that know what's going on around every single flip that they've financed. I mean, everything going on, and they're tracking it by the asset. And they know that some of their competitors have no idea, and I think they're maneuvering more quickly than them.
I think one of the big takeaways from what John is saying in regards to answer that question is people want community right now, right? We've had the same thing happen, John. I run a business with a lot of talented customers, and I can hardly get them to return a text message. But right now, every Friday at 2:00 at the Collective Genius, we have our all hands on deck call, and we are breaking capacity of our Zoom account because everybody wants community and they want data as quickly as it will come, as quickly as they can get it. So it's very much the same for us over here. What advice would you give to those who have rehabs in progress and whose P&L show green but the bank account is red? Mr. Cava, we've had this discussion. I'll let you answer that. Get lean, get liquid, and get out. Go for it, man.
That's it.
That's it.
There's a little confusion, John, on what you were saying on multifamily. What would you do right now with multifamily?
I mean, if I owned an apartment where 10% of people weren't paying rent, I mean, I don't know what you can do. I mean, there's a bunch of questions here about loan mods. I mean, a loan modification is coming. So we need some creative loan modification. If you're fortunate enough to be financed by Fannie and Freddie, they're giving you a hall pass on paying your mortgage for the next few months, but they didn't forgive it. I actually wonder if the government's just gonna, since they own it, if they're just gonna loan mod everybody and have the federal government take the pain.
Take a huge hit. One of the statistics you gave us in December was that there was a massive housing shortage, numbers versus households, and households being created. If I remember properly, and I don't have the data in front of me, but in 2008, I feel like that was the same thing. So coming on the other side of this, what does that look like? Because we're clearly going into some type of a pullback. What does that mean when there's just not enough housing?
So I don't think I said that, because I've been the person disagreeing with that statement this entire cycle. I mean, we wrote that housing demographics book, Big Shifts Ahead, 4 years ago, and concluded that on average, we need about 1.4 million housing units built every year. And we've been building 1.4 million housing units. And so I think that housing shortage comment is consensus of people who have not done the analysis. So I don't agree with that. I mean, if you look at the middle of last year, we were building 1.4 million housing units. We had stable interest rates. We had a stable economy. Home prices were going up at the same rate as incomes. That's a balanced housing market. We had a balanced housing market in the middle of last year.
That makes sense.
And that's a national, well, I'm saying that's a national comment. Clearly there were submarkets where demand was exceeding supply and vice versa.
One of the questions that's asked here, and I think the answer, I've talked to Devin about this in the past, can John provide submarket data that may provide guesses of the house supply and demand? This person's in Denver, will influence pricing and demand. I mean, that's your subscription, right? That's what you guys have for sale.
Well, our subscription, for the most part, is very metro level oriented. And if you really need to get site specific, our consulting team does that. We're not the ones that have data on every single community and access to every single MLS. We're kind of a level above that, just to be frank.
Got it. Jason, I feel like we've run through the questions pretty well. Go ahead.
Yeah, I think so too. So hang on one second here. So John, I think that's a wrap. I want to express my gratitude for you jumping on. A lot of people are already asking if, and I want to ask before I promise this or don't promise it. A lot of people are asking if they can have the slides. You've sent them to me. Either answer is okay. I don't know. I just didn't want to send it out without asking. So let us know if that's okay. Either way, they're going to get the replay of this call. So are you okay with that, or do you need to keep those close to the vest?
That's fine. I called that down from just some of the stuff we're doing, and I know somebody asked about getting access to our webinars. I mean, that would be contacting me and helping you out as a client. Just to get it out, that the minimum cost on that is really $3,000 a month. So,
Okay.
I mean, you've got an appetite.
And if they want to learn, more about you guys, they can go to, is it johnburnsconsulting.com?
realestateconsulting.com.
Yeah, if you guys want to learn more about John, you can go to realestateconsulting.com. He's someone that comes to our annual meeting each year in December and continues to share this data with us. And obviously that data has been helpful to this point. It's become challenging now because we've had something that's unexpected. But for those of you who want to, again, I want to thank John. Appreciate you, sir. If you've got to run, you're more than welcome to do so. And for those of you that would like to stick around, we're going to bang this out for a few minutes and just talking about something that I think this call probably reinforced, in that dispositions as an investor are going to be king. So what we wanted to talk about is, one of the questions that I'd asked on this survey that we sent out was, what have you done with your marketing spend for? What have you done with your marketing spend for in buyers? And the biggest takeaway on here, the biggest vote was, I wasn't really marketing through buyers because the market was good and I didn't have to. That is no longer acceptable. You are going to have to push full force ahead, and he or she who markets the best for in buyers is going to be the winner. So one of the things that we've been doing inside of our organization, Frank, I'm going to ask you to kind of tackle this with me, is we have been doing a deep dive. This is actually a call from yesterday or the day before, a deep dive into pandemic dispositions. And so the thing that I wanted to share with you guys is that John talked about his people wanting community, and our community has come together to effectively attack this, right? That's what we do. That's what a mastermind is. And so our deep dive has really kind of tackled some of the uncertainties in the market, right? Everything that we addressed on here as far as the capital markets, the buy boxes, showing and buying and selling houses, all of that requires new processes. It's not just knowing what you should do, but there's a lot of processes that have to go into place. And then what we just talked about from a marketing perspective, is it the chicken or the egg? Do I market for sellers or do I market for buyers? And that has obviously switched and gone around. So the way that we're attacking things, and you may want to do this with your team on a regular basis, we've broken down the core components of the business, right? Dispositions, we have a call today at 2 o'clock, and we'll be tackling this, right? What are you doing to keep buyers engaged? How are you communicating? What are you doing to 10x your buyers list? Are you doing Zoom calls to become the leader in the business? We're tackling all of this from a dispositions, lenders, rentals perspective, market observations we're seeing, marketing changes that need to be required, and then finally from a community perspective, because that's what we come together to be each and every Friday. And the thing that I want to stress to everybody right now here, if you're a leader, you need to remind, whether it's your employees, whether it's your family, whether it's your business partners, that you are a community. That's what everybody wants right now. There's a reason that all those people are showing up on John's call. There's a reason everybody's showing up now on our all hands on deck calls. And you need to remember who you are, what you stand for, and what you stand against, because things are going to get choppy over the next 12 to 24 months. And if you don't know where you stand from a values perspective, you could find yourself in some real trouble, right? And so I just want to remind everybody of that. And then the other thing that I want to share with you, that making money is one skill set, keeping it is a discipline. Making money is a skill set, keeping it is a discipline. I would encourage everybody to write that down, because if you can remember that, you can put yourself in a position where this doesn't happen again. So we want to talk a little bit about our all hands on deck calls. We encourage you guys, whether you do this on a local level or get involved in some community, or whether it's ours, that it's not just about what you're talking about, but who you're talking about it with, right? Would you look at this screen right here? We have some of the biggest players in the business on this screen, whether it's Lee Arnold, who, guy has 50 plus employees, knocks it out of the park, whether it's Frank Cava, who's on this call right here, whether it's Brett Snodgrass, who flips, several hundred properties a year. We've got the best players in the business right now, and we're coming together every Friday to tackle this stuff. And so I want to give you guys just some guidance of what our members are doing. Obviously, we can't share great detail, but the key thing is that we're having a plan, and our members right now are sharing their plans, their 30, 60, and 90-day plans that they built out and chunked down with each other, so they don't have to start from scratch, and they can share and get leverage from one another. Then what we're looking at from a dispo perspective is, where are people buying? Where are the hot spots? How is that changing, right? And now this is one of the things that's most important. When you are tackling new buyers, we are using data analytics to figure out who the buyers are on a weekly basis and how much are they paying relative to market value, because the folks that are paying the most are the folks that you're going to need to attack in this marketplace, right? But it's one thing, just because you have a list and you know how much they're paying, right? You have to go and actually attack finding out who own those companies, okay? And so we're sharing those documents, those systems, walking through batch skip tracing for those LLCs. We are charging ahead. Mr. Cava, you can give insight on this, right? Even once you have your strategy, if you're hiring for dispositions, this shows right here that you are actually figuring out the PI index, the behavioral index for the right dispositions folks, what their COG scores are. Like, we are digging into this in deep detail, and everybody brings a different piece to the pie, and then everybody in CG gets the entire pie from one another. So, Mr. Cava, you want to shed some light on this a little bit?
Yes. So here's an example of something that we did in our business on how we can quickly run through resumes. So my question for you is, who in here has plenty of extra time in their day? I don't know about your life, but since this all happened, I seem to have, I go the less distance and I seem to be doing more work. But that being the case, what we did is we came up with, we'd like to get people in a dispositions role. So we identified 4 characteristics or job descriptions or kind of descriptors of inside of the PI, which is predictive index. And then what we did is we just sent them a link that was with the job description, and with the application was, click on this, and there was 2 different tests. So we can tell very quickly by scrolling down the screen, if you're not one of those 4 people, we're not going to even call you back. And if you didn't follow instructions and take the COG score, and we can't look at what that is for you, we're not going to consider you as a candidate. So we are able to go through and look at 75 candidates in about 5 minutes. And this is a strategy. So if you don't have PI or any of this other stuff, you're speaking Greek to me, Frank, this doesn't help. This is what it does do. It takes a very, very complicated system, and it breaks down for you how you can very quickly have a not complicated system that takes 5 minutes instead of 5 days. And then if you say, hey, Frank, I'm really interested, which many people in the group have, can you put me in touch with the person that got you PI? I make a text, you can get signed up for PI within a couple of hours. So if you want to take the system that took me a couple of weeks to figure out, you can copy it in a couple of hours with a couple of contacts that Jason, Leon, or I can make inside of CG. That's the beauty of a mastermind. You get to stand up on the back of someone else who's built something.
Yeah, so the key is there's a lot of moving parts, whether it's finding out who the right buyers are via data analytics, whether it's skip tracing them, whether it's understanding the scripts to reach out to those individuals and create relationships, whether it's figuring out the right PI profiles for the right dispositions folks, the job description, all of that stuff is part of the organization, which we call the collective genius. And my point to you is, listen, obviously we're telling you a little bit about what we do, but go find an organization, whether it's ours or some other community, where the amount of time that our members save by being able, Frank has this figured out. He can give his system to everyone else, right? The data analytics, someone in our organization has that figured out. They can give it to everyone else as soon as they figure it out, right? So we want to leave you with a question. Who's doing the heavy lifting, you or your Rolodex? I can assure you right now, the folks with the best Rolodex are going to win. If you'd like to learn more about us, first and foremost, I want to tell you that we were honored to have served you. I think that call completely rocked. John was selfless in coming on and doing that. I hope we added a ton of value to you. If you'd like to learn a little bit more about us and let our Rolodex do your heavy lifting, here's where you can learn about us. Learn more about cg.com. Learn more about cg.com. We are a high-level organization. We are not for everybody. We're only looking for people that flip a minimum of 50 houses a year or have at least 50 rentals. And our job is not only to help you prosper, but to help you protect your business moving forward. I'm going to, Frank and Leon, just totally you're all called to stay. I'm going to share with some folks what has put me in a very fortunate position right now to not have to be too stressed about what's going on. And that is where a lot of people during this time are being exposed. And things are complicated right now because a lot of investors didn't put enough emphasis on cash management. It's all been about scaling, more deals, bigger portfolios, and not really a lot of emphasis on cash management. And I want to share with you a little bit how this is something that after getting punched in the face 2 times in my life, I was ready for the 3rd one, okay? And this is something I'm passionate about. It's something that these 2 gentlemen can tell you for years. I've been banging the drum on, not only with them, but with our members as a whole. And that is that when you're running a business, things can get complicated. You're raising capital, you've got private money coming in, you've got payments going out, debt service, you've got a ton of projects with different receipts. It can get complicated when you're running a business. And you've got to move to a place where cash management shifts from just looking at your bank statement every now and then to actually examining your P&L. And this goes back to the slide that I first shared with everybody when we got on here, my slide. And it said that profit is something more than a number that shows up on the bottom right-hand corner of your P&L. Profit has got to be something that's physically extracted to protect your business and protect your family. And when you don't have that set up, when you don't have a systematic process to extract that profit, it becomes very difficult to know what is yours and what is not, because it all gets jumbled, right? And so I want to share a system with you guys. I'm probably going to be doing another training on this in a couple of weeks with the gentleman that taught this to me. This is very simple. I have 5 different accounts: cash flow account, investing account, personal checking, tax, and short-term investments, and liquid hands cash off. I methodically and with a high level of discipline routinely take money from my cash flow account based upon profitability and put it over into my CG retained earnings account. I do the same from a liquid hands off perspective because that's for my family for times like these. Both of those 2 accounts take care of my business and my family in times like these. Tax and short-term investment, that's easily explainable. You cannot wake up and have a surprise tax bill. You cannot outstrip your profitability from a scaling perspective. You've got to routinely pull out money for taxes. Personal checking needs no explanation. This is, I said earlier, making money is a skill set, keeping it is a discipline. Super passionate about what I'm sharing with everybody right now. I would encourage you to go get a book called Profit First. I'm going to be bringing the author on to a call just like this in a couple of weeks. And we will walk you through this in detail. I can tell you it is not complicated. It can have different level of complications based upon your business. But at the end of the day, this is all fancy word and verbiage for save some damn money, period. Because things like this happen. Well, I didn't expect it. Didn't expect this. Didn't expect 2008. Didn't expect 9/11, right? Expect the unexpected. Put a simple discipline in your business that implements this type of structure. And yes, there's ways along the bull run where it's going to cost you opportunity, where you're going to have enough discipline to hold on to cash. But in times like these, it will give you a peace of mind that is completely different than if you're cash strapped. So with that said, it was an honor to have served you. Gentlemen, I would like to thank my team, Mr. Frank Cava and Leon Barnes. These guys are rock stars. And again, if we can help you as an organization and you are a high caliber investor, come and check us out. Learn more about cg.com. Mr. Cava, Mr. Barnes, if you have anything to add, go for it. If not, we'll sign off.
For our members, we will see you at 2 o'clock. For our non-members, everything Jason's talked about, if you become a member, it's all recorded. So everything that we've done for the last 6 weeks, we'll share with you once you become a member, and you can get access to it as soon as you become a member. So if you're like, I'm struggling right now, we've got a ton of resources that we've already put out in the last 6 weeks, and we're going to continue to do that.
And we only talked about one segment. We only talked about one segment today, right? We only talked about dispositions. We're doing the same from a capital raising perspective. We're doing the same from a sales process perspective that has to work inside of shelter in place. Like we're attacking all of it, everything. We only showed you one component today. So
yeah, and I just wanted to add one thing to what Frank said is this is immediate. So for the first time in 10 years, we're allowing our members to jump on board immediately. So I look forward to talking to a lot of you soon. Thank you.
You don't have to wait for a physical meeting, which we usually have every quarter. You can saddle up, strap in, and get on our all hands on deck call every single Friday. So with that said, we appreciate you guys. Take care of your business, take care of your families, and we will talk to you soon. And yes, we will send out the replay of this in addition to the slides. It's going to take a couple of days to get it built out. Be patient with us. We'll send you this, we'll send you the slides, and we'll send you the results of the survey if you took it. Thank you very much. Bye-bye.